When you invest in taxable accounts, also known as brokerage accounts like Fidelity, Charles Schwab, or SoFi to name a few, the problem is that you are going to be taxed on the income and capital gains that are generated no matter if you touched your investments or not, and many times these could even be triggered without you even knowing. And so the impact that this has on your investments over time is called tax drag, which can easily cost nearly anyone watching this hundreds of thousands of dollars over time. In fact, if you just started investing and contributed $1,000 per month, averaging an after-tax return of 10% over 30 years, then your end portfolio would be just over $2 million. But if you had a 2% tax drag, which could easily be if you don't watch this video until the end, then your after-tax return will actually be 8% per year, and over 30 years, you would instead have an end portfolio of $1.4 million, which is a $600,000 difference. And so no matter how much you invest, tax drag is like a slow leak in your gas tank where unless you fix it, it'll continue to eat away at your wallet over time. So knowing that, if you follow each of the 5 strategies that I'm about to discuss, I have no doubts that your financial future could be improved significantly. And all I ask is that if you do find value in this content, that you consider hitting the like and subscribe button with notifications on for future content like this. With that said, the first strategy is to invest into equity index funds, and if you have the choice, to go with ETFs. You see, because we're talking about investing accounts that can force you to pay taxes, you really want to go with the most tax efficient investments, and so one thing I really want to mention here is called asset location. As you can see, this visual shows some of the best tax efficient investments like small and large cap growth stocks compared to the least tax efficient investments like high yield and global bonds. But an even simpler image here shows the least to most tax efficient investments, where most of the options that are fine in taxable accounts are equity index funds, and that's because they typically pay low dividends, which oftentimes can be treated as qualified dividends that are taxed in the long-term capital gains bracket, which I'll cover more on shortly. But also understand that equity index funds usually have lower turnover rates, which is how often the underlying holdings in the fund change the positions. And so the low turnover is exactly why it's not a huge deal on whether you own an index ETF or an index mutual fund, but if you have the choice, your safest bet would be to go with ETFs. Now, if you don't understand the differences between ETFs and mutual funds, I've recently made an entire video on this topic, which I highly recommend checking out after this video, and I'll have it linked in the description below with other relevant videos that I've created. But to sum it up, both ETFs and mutual funds are a type of investment fund that allow you to invest into hundreds to thousands of different investments all within one purchase. And so the biggest difference between the two is how they are structured, where ETFs are known to be more tax efficient, giving you more control over the taxes that are triggered. Like I said, please understand that index mutual funds are also very tax efficient, many times the exact same as ETFs, but there are times that taxes could be triggered that are completely out of your control. I've covered this in great detail in a recent video, but especially if you own an actively managed fund, that would typically be much worse, and you would especially want to avoid that in taxable accounts. And then the last reason on why strong equity index funds are recommended is because they have actual proof of achieving great returns for long-term investors. You see, one of the most known indexes referred to as the stock market benchmark is the S&P 500, which tracks 500 of the leading publicly traded US-based companies, and since 1928, the index has generated just over a 10% annual return for investors. All this means is that if you believe the US economy is going to continue growing in the future, that buying and holding an index fund like this would be among the best investment that you can choose for a taxable account. In fact, if you were to simply buy Vanguard's S&P 500 ETF with the ticker VOO that has a 0.03% expense ratio, you wouldn't even notice the difference in that cost. The only thing you will notice if you buy this investment in a taxable account is that the dividends are going to be taxed, but with a strong equity index fund like the S&P 500, typically those will be qualified dividends if you hold them long, and that can make the dividend income taxed in the long-term capital gains tax bracket. With that said, the next section to know about is investing into stocks with low or no dividends. Remember that no matter if you reinvest dividends or not, the income will trigger taxes. This is exactly why, especially for long-term investing in taxable accounts, that you should avoid real estate investment trust companies, short for REITs, bonds, or high income producing investments like the popular JPI or JPQ. The reason for that is that those investments mostly trigger ordinary dividends that are taxed on top of your ordinary income at the rates between 10 to 37%. So to reduce your tax burden and maximize your long-term benefits, aiming for the more growth-oriented stocks will actually reduce your tax rate significantly and potentially allow for even more growth on your investments over time. This is because growth stocks typically don't pay out the dividends to investors because they would rather reinvest those dividends back into the company for future growth. As I mentioned, the S&P 500 allows you to gain exposure to large, strong growing companies, and it adjusts over time so you don't have to worry about picking the right stocks. But the fund as a whole right now has a 1.3% yield, which isn't super high. Then another option I want to briefly mention for taxable accounts that is more growth oriented is Charles Schwab's US Large Cap Growth ETF with the ticker SCHG that has a 0.04% expense ratio. Historically, it's done very well for investors and currently contains 229 holdings that are large cap US equities that exhibit growth style characteristics. But above all, due to being more growth oriented, this fund has averaged a 0.5% dividend yield over the past 12 months. Of a $100,000 investment, a 0.5% yield would trigger $500 in income, and the highest long-term capital gains that you would have to pay would be $100 in taxes, which that equates to being a 0.1% impact on your overall after-tax return. Now, if you are one super interested in building a dividend portfolio to live off the income before you can use retirement accounts like the Roth IRA at the age of 59.5 or above, I highly recommend, if this is your goal, depending on your current age, to slowly transition from growth to dividends over time. And not just that, but also make sure that they are qualified dividends for the long-term capital gains tax rates rather than ordinary income. In fact, one of my favorite strong dividend paying index funds is Charles Schwab's with the ticker SCHD, and if you look up the qualified dividend income percentage for 2024, you can see that in fact 100% of the dividends were qualified if you held them long enough. Knowing that, the next two strategies are more so approaches that may best align with your position investing into the markets, with the first being dollar cost averaging. When you hear about dollar cost averaging over time, this is pretty much an investing strategy where you invest your money on a consistent basis into the stock market over time. And so this image right here shows a bear market scenario where the share price of an investment is $100 per share, and if every month you invested $1,000, your average cost per share would end up being $82.75, where if you bought it all at the beginning at $100 per share, you would now be down to $70. So that would result in a much bigger loss, and is exactly why dollar cost averaging over time reduces the risk of trying to properly time the market. Now understand that the frequency that you invest could be whatever suits your position, like doing it weekly, bi-weekly, or monthly out of your paycheck. The biggest thing is that you are consistently investing into the market, because the impact over time adds up a ton. In fact, let's say that you had $0 today and start investing $1,000 per month into the S&P 500, assuming around a 10% after-tax return. After 30 years of doing this, you would end with having just over a $2 million portfolio, which you could easily set up automatic features to pull straight from your bank account on a certain day or days in the month, so that you know you are investing into exactly what you want and where you want. Now, the reason I'm even mentioning dollar cost averaging is because I highly recommend that everyone watching this considers doing it with your paycheck on a recurring basis. That way, you know you're consistently investing in the market with the goal to compound your money as much as you can over time. In fact, a quote from Warren Buffett on this really stuck to me, where he said, "If you like spending 6 to 8 hours per week working on investments, do it. And if not, then dollar cost average into index funds." Knowing that, let's now move on to the number 4 strategy, that is lump sum investing. Now, there have been numerous studies between lump sum investing, which is putting all your money into the market at one time, compared to dollar cost averaging, which is consistently investing into the market on a recurring basis. And so of the studies, the majority have come to find out that many times lump sum investing would be superior to dollar cost averaging. And the reason is that if you have the money to invest, if you split that over a 12 or 24 month period to invest it over time, then you are missing out on time in the market, potentially missing out on some of the best days that there could be. You see, this visual shows that if you invested $10,000 into the S&P 500 for 20 years, that you would end with $71,750. But if you missed the 5 best market days in that period, that would lower your end return to $45,000. If you missed the 10 best days, that would be $32,000. If you missed 15, that'd be $24,000. If you missed 20, it'd be $19,000, and 25 days would be $15,000. All in all, the data shows that although there is more risk associated with lump sum investing, on average, it tends to outperform dollar cost averaging. So let's just say that all of a sudden you receive a large bonus, you sell an asset like real estate, inherit money, or any other form of taking in a lump sum where you want to invest in the stock market, just understand what the legendary investor Ray Dalio said on how trying to time the stock market is harder than competing in the Olympics. Let that sink in, and if you do receive a lump sum, really consider doing it sooner than later and not wasting time in the market. And to give you some confidence with your investing strategy, if you look at the previous years of the S&P 500, majority of them have turned out green. Knowing that, the last strategy to taxable investing is to hold your investments longer than 1 year. This one's really important to understand because if you hold your investment for more than 1 year, that is considered a long-term capital gain in the tax bracket of 0, 15, or 20%, depending on your income. Where if you were to trade stocks or simply just buy and sell an investment within a year of owning it, the gains will be considered short-term capital gains triggered toward your ordinary income between the range of 10 to 37%. So a simple example here to understand is, let's say you bought $10,000 of your favorite stock and that doubled in value to $20,000 after 10 months. So you decided to sell it for a $10,000 profit. Let's just say that you're married filing jointly and your total income was $115,000. If you include the short-term capital gain, that would make it $125,000. And so by using the standard deduction that is $30,000 in the year of 2025, that $10,000 would be taxed in the 12% ordinary income rate, which means on a $10,000 gain, that would be a $1,200 tax bill. But if you instead waited a few more months until after a full year to sell it, that means that your $10,000 gain would actually be taxed in the 0% tax bracket from long-term capital gains, which would result in no taxes due. And do understand that that is excluding any state or local income taxes that you may have. But no matter what, if you hold your investments longer than 1 year before you sell them, your gains will be treated much better as far as taxes. And either way, the longer that you hold strong investments like the S&P 500, the more likely you are to actually see growth within your portfolio. Now, if you're interested to learn more, I've also made many other videos on YouTube and free learning guides that I'll have linked in the description below. And while you're at it, if you want to see some of the top financial products to consider, I'll have direct links to many options that may very well interest you, which depending on the ones that you get started with, I may earn a commission for it, which is greatly appreciated. End of the day, I want you to do what's best for yourself so that you can improve your finances, but also know that I show exactly how I allocate each of my investments through a private Patreon linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.